18% is way too much money to be paying to have working capital. Hey guys, my name is David. Since 2018, I've done a little over 30 million in ground up construction. That's a combination of building subdivisions, building single family homes, and townhouse complexes. Between 2024 and today, I've been helping my brother take his fix and flip business from 9 million to just about 14 million. And there's things I've noticed between the new construction and the fix and flip in my time of being in this industry since I was 15, which was over 2 decades ago. And right now, the most prominent problem for flippers is the cost of capital. I was on the phone with a hard money lender earlier today, and he was quoting me 16% on the interest and 2 points for closing. That's 18% on the cost of capital. And not all money is that expensive, but our average private money lender is collecting between 12 and 14%. And it's too much money. It's too much money to be giving away to somebody who's not sitting there in the trenches with you, waking up every day, grinding it out, and going hard, going aggressively to get the project done. They're just sitting back and collecting the money. And what I wanted to talk about is how that contrasts with new construction. In new construction, right now, you can get money between 7.75% and 9%. So that's almost half what that hard money lender was quoting me and just about half of what we're paying. And the crazy thing is banks won't touch fix and flip projects. I spent 3 months petitioning banks, guys who we did business with in a new construction capacity, but they were unwilling to touch a fix and flip reno. And if they were going to do it, the terms were so bad and the draw schedules were so prohibitive that it wasn't worth the trouble. We just paid the extra points on it. But we don't have any of those hurdles inside of new construction. The way financing would typically work in new construction, let's say we're building a spec home. $500,000 is what the house is worth when completed. Well, first we're going to have to get the land, and then we'll have to get a construction facility. And in some cases, if you work with the right lending institution, they are both going to be your land purchase and your construction loan, and they'll combine the two into one closing. The way the capital stack works looks something like this. Say the land is $100,000 and you need $300,000 for construction costs. The bank's going to want 20% of this land acquisition. So you're going to have to come out of pocket 20 grand. You're going to have to come out of pocket about another 10 grand to get your drawings, and then maybe another 2 to 3 grand on your appraisal. Then you're going to take that appraisal, those drawings, and that 20 grand of down payment to the bank, and they're going to give you that $300,000 towards your construction. And they're going to give you that money incrementally in draw schedules. Now, I know a lot of fix and flippers get nervous about draw schedules because they think they're prohibitive. But the thing is, in new construction, is every single phase, depending on the municipality, will require some level of inspection. And so you schedule your bank inspections at the same time as your building inspector inspections. So it really never actually causes any delays. So we put our 20 grand down, we spent our 10 to 20,000 on entitlements, and now for call it $40,000, we're building an asset worth 500 to 550. Private money lenders pretty much operate the same way. Now, we have good relationships because we have guys that we've worked with for a very long time, and they, depending on the lender, will lend 100% on acquisition and 100% on rehabs, but that's not always the case. There's a lot of hard money guys out there who only want to give, say, 90% on acquisition and then 80% of rehab. And so you're still covering the difference in cost there out of your own pocket. And that inability to keep cash inside of your business, at least we've found that inability to have the cash to use just bottlenecks the bandwidth for growth. The scenario I just described on building a $500,000 spec house, you don't have those same bottlenecks, because what you do is you build a management fee and you build a cost overrun fee into your draw schedule. And by doing that, you always have a little bit of cushion to where you've borrowed more money than you actually need. Whether you choose to draw it down or not is entirely up to you, but that cushion is built in. So you're never in a position where you've got 20 grand of your money in this deal, 50 grand of your money in that deal, 80 grand of your money in that deal. You don't do that. In new construction, assuming you have the right structure with the right product and there's enough profitability in there, you're borrowing against the future value of that home. In fix and flip terms, we would call it ARV, but it's not ARV because it's new construction. So you're going to appraise your drawings on that lot, and let's say it appraises for $500,000. Well, the bank is going to loan you up to 80% of that $500,000, and that 80% will include your land and your construction costs. If you structure the right deal, you should have about a 25 to 30% margin in that home, so you don't even need to borrow all the money that's available to you.